Okay, welcome to our final session. It's a fireside chat with Presidents Bostic and Hammack from Atlanta and Cleveland. It's going to be moderated by Brian Chung from NBC. Take it away, Brian. You've got 1 hour until noon. Thank you.
Yeah. Great. Thank you so much, Mark. Appreciate all of you having me here at the Federal Reserve Bank of Dallas. Just to introduce myself, my name is Brian Chung. I am a business and data correspondent with NBC News. It is a pleasure to be joined here this morning with the Cleveland Federal Reserve President, Beth Hammack, as well as Atlanta Fed President, Raphael Bostic. And I think I'll just begin by having you say any hellos, any remarks you'd like to say to the crowd, as well as any disclaimers as well if you need to.
I'm thrilled to be here. I think it's been a great agenda and really appreciate working with President Logan and her staff and President Bostic in pulling this together. I think it's been a good session to get people talking about some of the changes happening in bank funding. And so appreciate everyone coming and everyone participating. And I will say the health warning that we always say, that the views I present are my own and not necessarily those of the Federal Reserve Bank of Cleveland or the system.
I'll just say +1 to everything she said. And just to say, like, this has been a great conference. I think it's really important that the Fed system does these sort of things. And it's just been a joy to work both with Beth's team and Lori's team to put together a program that's been quite interesting. I hope you all have gotten nuggets to take with you to think about how we might move forward to improve the systems and make sure that we have a banking system and a payment system that continues to serve the needs of all Americans.
And +2, my views also do not reflect the views of the Federal Reserve Board or the system. But I wanted to start off with a little bit of a fun question, because obviously there's a lot of news going on. We'll talk about the economy. We'll go into some of the nitty-gritty of what's going on in the bank funding space. But as I was walking into the Federal Reserve Bank of Dallas today, it was my first time here, I saw there was something on one of the screens on the pillars coming in that said there was a watch party of some sort for the FOMC press conference, which happened on Wednesday, which got me a little nervous as someone that is in the press room asking questions of the Fed chair. So I wanted to ask, what do you do as Fed presidents during the Fed press conference? So the decision comes out at 2 p.m. and at 2:30, are you still in DC? Are you already off to the airport? Like, where are you guys? What are you doing?
So it kind of depends on the day. The meeting usually ends by something like 10:15 or 10:30 on that day. And so generally the presidents, sometimes I'll catch a plane back to Cleveland, so I'll be on the plane when the press conference is happening. Sometimes I'll do meetings on the Hill to meet with different congressmen and senators and just kind of hear their perspective and share some of the views that we have. But if I happen to be on the ground and available and have the time, I will sit and watch it very often.
It's the same. To be completely honest, I rarely see it live. So, we're running around. I'm not in DC all the time, so it's an opportunity to go see lots of folks. But if I happen to be on the plane, Delta shows CNBC, and I always turn that on.
Catch the live stream
to make sure I can see it live. But in general, they send us around sort of the transcripts afterwards, and there's always a way to see it. This is very interesting. But you always look great.
Oh, thank you. Very kind of you. Very kind of you. That's good to know. I didn't know if you guys all had like a big popcorn party or a pizza party or something like that somewhere.
No, but they do. Like, I know in our building they do have a watch party as well. And
we do in Cleveland too. Yeah.
Well, that's amazing. I want to now get to the substance of the meeting. So the Fed cutting interest rates again, second time, back-to-back meetings, back-to-back months. I wanted to get your clarity on what you decided on, because it seemed like there was a kind of fanning out of different views on whether or not the Fed should have cut interest rates by a quarter point. Did both of you support that decision on Wednesday?
So I eventually got behind it. I've been on record for most of this year that I thought that one cut would be appropriate as we tried to figure out how the economy is working. We have our mandates, their intention. There's weakness in the employment side, but there's also, we have not been at target for almost 5 years on the inflation side. And so figuring out which one is the most significant, I think, is important. I was able to get behind it because it's more than where I was, because I still think we're in restrictive territory. And that, to me, is the most important thing. We can't really signal or forget that inflation is a significant problem, and we have to get that back down to our 2% target. And I think we can still do it, but with each step, we get closer and closer to neutral in ways that make me uncomfortable.
Yeah, so I would have preferred to have held rates steady at this meeting and not have to reduce rates. As Raphael says, it's a challenging time for monetary policy. We're being challenged on both sides of the mandate. We have inflation that is too high. It's about a percentage point above our target and has been there for a long period of time. My projection is that it's going to stay there probably for the better part of next year before it starts making its way back down to 2%. And on the other side, we've seen some emerging signs of softness in the labor market that we need to be attentive to. There are a bunch of headlines that were out even this week about layoffs that are starting to happen. When we look at the data at the Cleveland Fed, we track that WARN notice data pretty closely. We're not seeing an uptick that's concerning, but these latest announcements will flow into the October data that we'll see in middle November. So we'll stay current on that. And so I think that given the move that we just made, I think we're right around my estimate of neutral. I think we're barely restrictive, if at all. And so I do think we need to maintain some amount of restriction to help bring inflation back down to target.
So Beth, just to build on that, now that you've said that you didn't necessarily support that cut yesterday or earlier this week, what is it about the inflation picture that has you worried? Do tariffs kind of bake into that concern, knowing that it's still only been a few months that we've seen some of this current administration's tariffs kind of starting to take bite?
So the inflation picture is not just tariffs. When I'm out with businesses and when I'm traveling through Columbus and Cincinnati and small towns like Worcester in Ohio, I do hear people focused on tariffs. I hear the manufacturers are talking about it, importers are talking about it, even retailers. If you're running a grocery store, they're talking about tariffs, and they've been absorbing some amount of those costs. But they are starting to get to the end of that. They've gone into that margin compression about as far as they can, from what I'm hearing, and that they'll need to start passing that on in the near future. But tariffs are really just one piece of the puzzle. I'm also hearing about concerns about electricity prices are continuing to rise, insurance prices are rising, whether it's property and casualty or health insurance. And so it's much more broad-based. And so one of the things that I'm focused on is it's if you look at that core services ex housing, there's been little to no progress in that over really the past year. We were at 3.6 last August. We were at 3.4 at its most recent reading in August, which is up from where it had come down to earlier in the year. And so to me, that's not tariff related. It's hard for me to see that core services ex housing is being driven by tariffs. And so you take that plus the tariffs, and that to me creates a more concerning picture.
And I would just emphasize exactly what Beth said in the sense that we have a survey center. We do run a lot of surveys. We've been asking businesses sort of, are you feeling price pressures? They all say yes. What is the source of it? And one thing that's been interesting, less than half of the source of upper pricing pressures are being reported as tariffs. It's about 40%, and I think in our survey of business uncertainty. So it is much more broad, and the stalling out of the progress that we've been making. We've made great progress. Inflation was much higher than this 2 years ago, but we haven't gotten all the way there. And we are committed. I'm committed to making sure that we get to that 2% target, and we're going to have to do more and see more progress before I'll be comfortable getting us all the way back to neutral.
And you mentioned even on this decision, Raphael, for you did support the rate cut, but you had to eventually get there. I mean, tell me about the change in thinking, especially knowing that we're kind of, as the Fed chairman described it, driving through fog right now with the absence of at least on the labor market side of things, jobs data coming from the Bureau of Labor Statistics.
So I'm going to say two things on this. So one, I actually really like the fog analogy. I think it really describes for me an approach, a philosophical approach to doing policy, which is when there's so much uncertainty, there's so little clarity, it's preferable to go slower. Take your time, don't rush to somewhere, because you may discover that you actually took a turn in the road that you didn't know because you couldn't see. So going slow, being moderate in approach is important. The second thing I did want to say, though, is that we're not completely flying blind. So at the Atlanta Fed, we have a whole survey center. 6,000 respondents give us information over a quarter. We have a bunch of advisory councils. We have 11 advisory councils that are sector pictures of individual sectors. We have a staff that goes out and talks in unstructured ways to leaders across the 6th district. We get maybe 100 or 120 of those in a cycle. And then we have 44 directors of boards across my 6 locations. So we get a lot of information. It's qualitatively different than what you get in the federal government side, but it is informative, and it does really allow us to have information that's useful. And I'm just talking about what we do. I know every one of my colleagues is doing the same thing, and that doesn't always get the kind of airplay that it could, but it is really important, particularly in a time where we're not getting the same volume of data from the federal government.
Yeah, what are you looking at, Beth?
Yeah, no, I'll just echo that. I think this is a moment when the reserve banks and the bank presidents really shine, because all of us are going out and spending time in our districts, getting to know individuals, businesses, communities, and getting a really robust picture of what's going on. But there is no, I don't want to overstate, I mean, it's critical information that we're getting, but I don't want to understate that, the BLS data is the gold standard of data the world around. And so having that does help complete the picture. Having longer data series that you're comparing things against does give us better visibility, but we absolutely have a lot of great information right now that we're relying on. And oftentimes when the economy is shifting and when you're at these pivot points, I find that these anecdotal conversations can be good leading indicators of where we're headed. So we'd be leaning heavily on this part of the information set anyway. It would be nice to have the BLS data to complement it, but it would really just be a complement.
And when we talk about the labor market, because that is where I guess we're not getting that gold standard data, because we did get one CPI report on inflation, albeit a little bit late. But on the labor market, it seems like the justification for doing these interest rate cuts is to make sure that there isn't any sort of substantial deterioration in the labor market, which I asked the Fed chair in presser on Wednesday, and he seemed to say, we're not seeing signs of significant deterioration, but look, we're keeping tabs on it. From your perspective, I mean, Beth, you mentioned there were these big splashy layoff announcements we saw from some companies, Amazon, UPS, Target, GM, the list goes on. In the absence of government data, are those anecdotes weighed a little bit more heavily? And how do you figure out what is going on in this labor market, since it's such an important part of the decisions and the policies that you're choosing to make as of the last 2 meetings?
Yeah, so I would say that when we moved in September, it was because we'd seen that sharp drop off in the payroll prints, right? We'd gone from being around 100,000 of new jobs being created to being, I think the average over the last 3 months that we have is about 29,000 per month. And so that was a notable drop off. Now there's a question of, is that supply driven or demand driven? Because it aligns with a pretty meaningful shift in terms of immigration policy. And so that I think was really the catalyst. Since that moment when we saw that shift down in job creation, we've been watching a whole host of other data. And so yes, we don't have the BLS numbers, but we do have the weekly state numbers coming through. And those have been low and pretty consistent with where we'd seen it. We are looking at things like the WARN notices, and as of its last reading, which went through September that we got in the middle of October, it had ticked up very slightly, but is still within historical ranges. The Chicago Fed had put together an indicator that they're using that helps to predict where things are coming, where the labor market is going to be. And so there's a host of other data that we're looking at that to me says maybe there's been a shift, but it's not obvious that shift is coming just from the demand side. I think there is a supply side to that story, but it would be really helpful to have more information to help round out that picture.
Yeah, Raphael, how do you see the labor market now?
Yeah, look, I think the labor market is incredibly difficult to interpret today. There's a lot of churn that's going on, and for me, one of the questions that I've been trying to focus on is to what extent are the changes driven by cyclical things as opposed to structural things? Now, we know that there are big structural things happening. I talk to businesses all the time. They tell us, we're a lot more reluctant to hire entry-level folks because we think that AI can do some of these things, and we're going to experiment, and we're going to try to figure those things out. I hear about those sort of technological changes influencing the demand for labor pretty significantly. Beth mentioned the immigration policy. That could wind up being a structural change that happens on the supply side. That could be significant. If you think about the changes in our trade policy, to the extent that that leads businesses to fundamentally change how they source inputs for their materials, that's also a structural change. And monetary policy doesn't do very well in influencing the trajectory of the economy if there are structural things that are going on. On the other hand, there are cyclical things. We have heard uniformly that the economy is slowing down, that for some consumers, there are stresses. They're feeling the pressures of high prices and starting to do things that are showing that stress, which is changing the demand for a lot of baseline products. We started hearing probably 3 or 4 months ago, lower income borrowers, low income households, um, moving their purchases from, say, pods for washing dishwashers or the washing machine to powder or liquid, because you can ration that. You don't have to fill it all the way to the one line. You can fill it a half and then get more out of those things. And people are smart. They can figure out how to make their dollars go as far as possible. So it's all those sorts of things that are out there. And our sentiment measures from business leaders, they all tell us they do feel like things are a little slower. But slower is not necessarily the same as weak or non-existent or troubling or whatever words you want to use. And we're not hearing the extreme words. It's interesting. In the last cycle, nobody asked about the probability of recession or when a recession is likely to come. That wasn't in people's mindset today. It's a risk, and so we have to be mindful that risks are out there. But it's, in some ways, I feel like the sentiment is such that the risk of those kind of catastrophic outcomes have receded pretty significantly. And it's been an interesting shift over the last several weeks.
So risk management then, which brings us to the question of the December meeting. So as someone that's been covering the Federal Reserve for a while, usually all we get is a policy is not on a preset course. What we got on Wednesday from the Fed chair was not only that, but December is not a foregone conclusion, and then far from it. We don't usually hear that. How are you thinking about December, knowing that it's still a few weeks away, but how are you approaching that meeting?
Well, we have a lot of time between now and then, and hopefully we'll get more data. Hopefully we'll get some of the hard data, but certainly we'll be out. Our teams are already out in the district talking to businesses and trying to get a perspective on how things are evolving. Um, the consumption data has been pretty healthy. We definitely are seeing this K-shaped or two-speed economy, however you want to think about it. And a lot of the consumption that we're seeing, a lot of that is coming from the higher income families, and that's been really sustaining the growth in GDP. And so that's something we need to watch, because we are hearing that there's a lot more pressure and a lot more pain in those lower income families, that they're just, it's interesting. You talk about kind of stretching the detergent or the washing powder. What we're hearing is even at a more affluent supermarket, they're saying that they're seeing 10 to 15% increase in promotional items. And regular items are not, they're not seeing growth in that. So you're seeing it even now starting to creep up that wealth spectrum, where I think it had been, we know that those lower income households know how to manage that. They're working hard to do that, but we're seeing that creep up a little bit. So again, this is a challenging time for monetary policy. We're gonna have to watch closely to see how things evolve. As I said, I would have preferred not to have gone at our most recent meeting, but I want to be very attentive to these announcements that are happening on the labor side. There may be something that I haven't seen in that labor picture that could be more signs of softness, and I want to be open-minded to that, because we do really need to balance both sides of our mandate. But right now, when I look at where we are on the unemployment side, we're missing our unemployment goal, maximum employment, to me by maybe a couple of tenths. And we're missing on our inflation side by a full percentage point. And I think that's going to persist for longer. And so when I weigh those two things against each other, I think we need to stay restrictive to continue to bring down inflation.
Yeah, I would say I was glad that the chair added those few words, if only because I was really concerned, and I've been concerned for a while, that a narrative would emerge that would suggest that we're on a march to somewhere, that there was an appreciation that we knew that we had a ways to go and we were just gonna go, independent of whatever information was gonna come out. And I mean, you can look at some of the market probabilities that were happening that was suggested that they started to think things were just marching and we were just going to go there and get there. And that was not where my head was. And I thought that the chair pretty accurately reflected the range of views that are that are on the committee, and that was information that needed to be out into the public domain. Um, I'm going to say every meeting is live. We're not on a preset course. We're going to let the information guide us. And I'm going to stop there so you can be happy.
Well, can I add one more thing to that?
Yeah,
I
please.
think the market tends to over-focus on the median from the SEP. And they take, I mean, you hear in different market commentators talking about that as a promise. It's not a promise. It's not forward guidance. It's our best view of what we think right monetary policy looks like. And in our September SEP, you saw a pretty notable difference between, there were 10 participants that thought there would be 3 cuts between September, October, and December. And then there were 9 participants that thought there would be, 2 or fewer cuts. We've already had 2 cuts now. And so if you even have one person who shifts their viewpoint, now that could shift. There's a lot of data that happens in between that September SEP and our December meeting. And so it is important to remember that we are not on a preset course. We are looking at it. And what that SEP does, if you actually look under the hood rather than just focusing on the median, there's a lot of information. It doesn't tell you who's voting and who's not voting, but it does give you a better sense of the range of viewpoints on the committee and how things may progress relative to our expectations.
Yeah, I'm just going to add that, the median is math, right? It is not a decision process. It's not a deliberation. It's not an argument. It's not any of these things. And I agree with Beth in the sense that people interpret a mathematical statistic as process, as a decision. Like when each of us puts in our dot, we have not talked to anybody else. We don't actually know what it's going to be. We find out what it is like Monday night, right just before the meeting starts. And so this is not something that reflects a decision. It's like, and I'll just say for me, my dot embodies an outlook, a narrative about where the economy is likely to go over the next 6 months, 12 months, 18 months. Each dot does that. But we have not talked about whether our outlooks are the same, what we think is going to happen, which ones are going to be more or less likely. And so that chart is a nice picture. I think one of the big values is that, just to make clear, there is a range of views of this, and that we're a deliberative body, and people are able to have their own view. But don't get too far ahead of us on this. Every meeting is live. We're going to be data dependent. We're going to do all the things that we need to make sure that the decision is appropriate at the time we have to make the decision.
And I do know this is a bank funding conference. I promise you there's a discount window question here coming in a second. But I just have to drill down on this one more time because, the SCP, we didn't even get one this week. And so, obviously we're expecting the next one next month. But this is a moment where the range of views is diverging at a level that I have not seen in a little while covering the Fed. And so, what was the tenor of, I guess, of the conversation, knowing that you have so many? I mean, in this room, we heard from President Logan earlier this morning, talking about her views on, the decision on Wednesday. We have 2 people in this room already that didn't necessarily support that quarter basis point cut. So, as a journalist, right? I go on the Today Show, I go on the Nightly News. I'm trying to explain to people what's going on with interest rates and what their borrowing costs are going to be. Market participants are watching, people playing Fed funds futures. They're all trying to figure this out right now. So where do we go from here? What is to be taken from the mixed messaging that seems to be a risk with all these diverging viewpoints?
I think you're hearing differing viewpoints because we want to make sure that we're doing our best for the American public, and it's not clear what the right answer is. And so what we have in the room is you have 19 participants who come in from very different backgrounds, very different sets of experiences, very different perspectives, and it's actually a really robust conversation. It was one of the things I found that was surprising to me. I've only been in the job for 15 months, but walking into that room, the level of care and thoughtfulness that each person brings to their commentary and how everyone listens so carefully to one another. You see people in the room changing and adapting their viewpoints and thinking about things differently. And it's a really collegial environment. I mean, I really go in there, and I will say I probably learn more from the people who see things very differently from me and who end up on different sides of things, and I really value those perspectives because it challenges me and helps me think about what am I missing? How can I make sure that I'm doing my best to deliver on our mandate?
I agree with that completely. It's a wonderful collection of people that I have the privilege of working with. I will also say, like in my 8.5 years of doing this job, this is the most difficult time to make a forecast. There are so many things that are moving and so many things that are changing. If you had 8 dimensions and there was a yes, no on 8 of them, for us not to be having different views, you'd have to have us all make the same decision about where we are on all those dimensions. And that is just not a likely thing to happen. So I think that the diversity is actually a positive reflection of the times that we are in. And the most important thing that I hope for and I'm seeing is that everyone is doing their honest best work. They're trying to do their best to discern what it is. And we may have different interpretations. You know, you talk about the cyclical versus the structural and labor markets. Some people think that it's mainly cyclical. Others might think it's mainly structural. You're going to wind up in different places naturally. The question about tariffs that you asked, are we through with the impact of tariffs on prices, or is it still some to come? People have genuine and legitimately different views on that. This is why trying to get data and have the data inform can actually help us come to a closer appreciation and agreement on where the world is, so that we can coalesce around an appropriate path for policy. And that's really going to be our task. It's always our task. We're going to have to double down on it over the next several weeks.
And can I just say, I think this is where our staff come in, and I just want to give a huge shout out to our staff, both at the reserve banks, but at the Board of Governors as well. They do an amazing job in sifting through a tremendous amount of data, running different scenarios, running different alternative simulations so that we can have a broad perspective of not just what a base case is, but what a risk management case would mean. And this is why we have research economists that help us think theoretically, big picture, long term, around how the economy might perform in different scenarios, might respond to different shocks. And that helps us to learn a lot so that we can hopefully do our best job.
Okay, so the bridge that I am now going to cross to go into bank funding is the balance sheet, where we also got the announcement this week that the runoff would be ending December 1. Walk us through the thinking on that, and what were you seeing in short-term funding markets that told you this was the time to do this?
So we've seen some pressure recently in repo funding markets. And so our target is the Fed funds rate. But the Fed funds market is a pretty small market relative to money markets broadly. And so the Fed funds market is about $100 billion. Repo markets broadly are more like $4 trillion. And so we have to look at a constellation of those things when we're thinking about how the balance sheet is performing. My viewpoint is that we are in an ample reserves regime. I think that's the appropriate regime for us to be operating in. I think it provides a low cost of reserves to the banking system. I think that's efficient for us to do as a central bank, to provide those reserves to the banking system. And what I want to see, like President Logan articulated in her speech, is that I want to see repo rates and money market rates trading roughly in line on average with IORB. And so what we've seen more recently is that as we've been running down our balance sheet, as we've been letting the roll-off happen, we've started to see more episodic movements. And so there are times when we're running at that level where TGCR is running in line with IORB, but then you have moments like today where there are big settlements in coupons, 58 billion of coupon settlements today, plus you have Canadian year-end, and you see more elevated pressure. And so we have tools that are set up to deal with that. Both the standing repo facility and the discount window would be another borrowing tool that banks could avail themselves of. Those are set at the top of the range. But it looks like a leaky ceiling. I don't know if you can call it a leaky ceiling, but it looks like some things, I don't know, the balloons are floating away when banks aren't participating and taking advantage of those tools that we have, like the standing repo facility, for them to be able to monetize it. And to me, the standing repo facility is just a way for us to implement monetary policy and for us to have effective rate control. Because even though our directive is in Fed funds, I agree with Lori that the market has shifted. The market has shifted quite dramatically since Fed funds was our primary tool.
Maybe
and I think
time
it's
for a new measuring stick?
I think it's time for us to look more broadly because we have very effective control over a $100 billion market. But the market is 4 trillion. And so you've got 3.9 trillion that's happening over here. We've got to be able to have some amount of control over there to be implementing effective monetary policy.
If you'd like to chime in on the Fed balance sheet. And then also tri-party.
Very little to chime in on. Beth has been working on this a long time. I will say, for me, there, I think we have, it's in our interest to limit the amount of volatility you get in terms of the functioning of these markets. And the spikes that we've been seeing in the last several days suggest that we're already seeing volatility. Going any appreciably lower than where we are now is just going to add to that and lead to disruptions and lead to having to do more continuous interventions in a way that is not really, I think, where we want to be. So, so I'm very comfortable with this, and I think for us, the next steps are going to be how do we navigate as the economy continues to grow, as these markets evolve, so that we are always positioning our balance sheet so that there is stability in the functioning. And those will be conversations that happen over the next several weeks.
Okay, so my question now that, I guess RIP QT for at least for this round, but is it mission accomplished on funding markets? Because obviously you have lots of flashbacks of the 2019 repo crisis. There are certainly concerns that, all right, well, if things flare up again, would you then have to potentially go back in and start buying assets again? Is that something that?
I mean, our balance sheet is a living, breathing thing, and it's not. There are elements of it that are within our control, and there are other elements where the subcomponents shift around for factors other than things that the New York desk is doing to help maintain control. So when Treasury's general account increases materially, that mechanically takes reserves out of the system. And so what we need to make sure that the ample reserve regime is working is we need to have good visibility as to what some of those fluctuations are going to be. And that's a very difficult thing to project. It's very difficult to know exactly how those changes are going to happen. Our goal was to end runoff at a point when we were just above ample so that we'd have some time to see how things were moving, and then could evaluate when the right moment was that we would want to grow reserves further. I think there's benefit for us in having the smallest possible balance sheet that we can while operating in that ample reserves framework, but it requires not just us watching the markets and understanding what that growth in reserves and currency is going to be. It also requires the primary dealers to help transmit and redistribute reserves throughout the system in an efficient fashion. That's what I think is one of the key roles of the primary dealers. And so it is disappointing when we put tools out there, tools that I might say they actually had requested. I think primary dealers were one of the key groups that suggested having a standing repo facility would help eliminate issues like we had in September of 2019. And so we've put that tool out there. It's available for them. I'd like to see them take advantage of it to help redistribute reserves throughout the system.
So you're a little more in the, we can run this in a very efficient way. I'd like a little extra buffer because I do think because the balance sheet is so dynamic, it is organic, and the world has become sort of more uncertain, the swings that might occur could be outsized relative to our experience. And so having that extra buffer, I think, gives us even more space to ensure that these facilities can provide the amount of liquidity that we will need at the point in time. The thing I do worry about is the facility may have a certain capacity they can serve, and we get some outsized unexpected shift, or 2 or 3 things move at the same time, we find we need more than that and are not positioned to handle that. So for me, I'd like to see more in the buffer, but the point, I mean, we probably should do an explainer on how the balance sheet evolves over time in ways that allows people to understand the dynamism that actually exists in it, because it is quite complex.
It'd be hard for me to convince the Today Show to want to do something on that, but maybe we can try.
I mean, the makeup of the balance sheet is not a sexy topic for mainstream America. I'm shocked.
I'll run it by Savannah Guthrie and see if we can make something happen. But this gets in an interesting point, which is that, semantically, there's a difference between how people assess the line of ample to abundant, right? And so I guess since even there seems to be here a little bit of different views on that, how do you think, where's the difference coming from? Is it also regulation, knowing that, if there are more stringent requirements that are requiring banks to hold on to liquidity, that requires there just to be, by sheer aggregate numbers, more in the system?
I don't know that we differ necessarily on how we determine ample versus abundant. I think it's maybe just our preference of how important is it to be just at ample versus abundant. I think Raphael is saying that he's okay if we're a little bit closer to abundant. I'm saying I'd prefer to stay just at ample. The way I judge it is the same way that Lori judges it, which is that is TGCR averaging generally where IORB is. That to me tells us that we're in that efficient, ample moment.
Let's go. I'm team abundant. I'll just say that. That's what we should get.
And I do want to remind the crowd that in a few minutes we're going to open it up for some questions and answers. So if you want to kind of cook up some questions, feel free to do so. We'll have the mic floating around. But you mentioned tools, Beth, the discount window. So there used to be a stigma. It was a bad market signal to have to tap the discount window. We saw during 2020 there was kind of a change in terms of trying to encourage banks to do so. There are obviously a large number of large banks in both of your districts. What does that conversation look like in terms of getting around that stigma? How should banks in 2025 be thinking about the discount window as an available tool?
So we have been working with the banks to help them understand that it is a tool that's there, that's meant for them to use if they need it. I don't think of it as a regular way funding tool. I don't think of it as sort of their first port of call. But if they're in a situation where they need to get more liquidity, and it will help provide that bridge for them to give them the liquidity they need to make it to be able to get into longer term funding options, that's what it's there for. And so we've been encouraging banks to think about, does it make sense for them? And if it does make sense for them, if it's part of their liquidity planning, their contingency planning, that they should test it out, they should position collateral, they should think about using it from time to time so that the first time you're using it is not in the middle of the stress, right? The reason that you run fire drills is because you want to know how you get out of the building in a fire before the fire has actually happened. And so I would say that the preparedness around the discount window is the same thing. We've seen really good progress, I'd say, within the 4th District in terms of banks moving to a place where they are ready to use it. It doesn't make sense for necessarily every financial institution. We've got over 200 financial institutions in the district. Some are very small. And for them to pre-position collateral just doesn't make sense because they'd rather not have it encumbered with us. They'd rather have the flexibility to do other things with it. And that's just fine. We just encourage people who do think of it as a tool that they want to use to be ready to use it. And I think we've been spending time as a system to look at how can we improve the discount window? How can we improve the ease of use and simplify it so that banks feel like they have the ability to take advantage of it if they need it?
Yeah, I think there are at least two aspects to this. One is what Beth was talking about, which is preparedness. And on some level, it's human nature to, as you get further away from a crisis, to think that you don't need as much insurance and coverage and protection and preparation. So, I lived in California for many, many years. The moment when earthquake insurance is at its highest is like 2 days after the earthquake. And from that point forward, people start dropping off as you get further and further away. So this beating the drum of it's here, you need to know how to use it, you need to make sure that you have people in the building who can do these things is quite important, because we know at the last crisis in Silicon Valley Bank and other institutions, they were not ready to use a tool that could have provided some help. And we want to make sure that that problem is not the problem. There may be other problems, but I don't want that one to be the problem. And the second thing that we've heard a lot is that the interfaces have been clunky. They're not user-friendly, and that can be a disincentive. So, we all, I was actually just on a chat line trying to manage some things, and, I typed in my question and it answered a different question. And if you start having those experiences, there's a natural impulse to just shut the whole thing down and just forget it, and I'll just not have to deal with it. And I don't want that to be a problem either. So we need to make sure, and there's been a lot of progress on this. You heard a bit about this with Discount Window Direct and other things. I hope for the bankers here, you're all using this and tapping into it. And please give us feedback. So if there are things that you think would be helpful, so we can continue to work on these things. But I think it's important for us as a system to make these tools as easily to use so that when things happen, the help that is available can actually be used. Because that would be the tragedy, that that there was help there that could have made a difference and it didn't make a difference for readiness reasons. That would be a shame.
I want to ask about stable coins. The pressures in money markets in 2020 were, I mean, 2020 obviously was crazy on many fronts, but that was a particularly interesting point because a lot of these prime funds had these huge outflows as a result of what was going on in crypto, what was happening in stable coins. Is that a risk to bank funding as well? And is there a solution to that? I mean, there's been some suggestion that maybe some Fed tool should be made available to some of these stable coins. Like, is that a thing that you think about?
I mean, stable coins is an exciting emerging technology, and I think time will tell what the use cases are going to be. Uh, I do feel like, you know, we hear from the banks and we hear from individuals that there is demand for being able to move money faster, and that's something that we need to be able to do. We put in place FedNow to help facilitate that, but I recognize that is still an alternate payment rail, and it's not. Um, it lives in a different ecosystem than some of the crypto and stablecoin universe, and so I think that there's a lot of opportunity, and I think there's a lot of experimentation that's currently happening. And we're going to learn a lot over the next couple of years just in how these technologies evolve, what those use cases look like. And I want to hear from the banks and I want to hear from businesses and individuals about where their priorities and preferences are, because it does shift over time. One of our core functions at the Fed is to help run the nation's payment system. And so we do need to be attentive to how changes are happening and make sure that we can provide good low-cost options for banks and individuals to move money where they need to, when they need to.
So when it comes to stablecoin, I think the biggest question is which use cases will emerge and which ones will become dominant. So one that I think there's been broad consensus that stablecoin will be helpful in is in cross-border payments. Uh, Pretty much everybody understands how that works and why there are going to be advantages to that moving forward. Other than that, you know, I talked to 10 different people. They have 30 different use cases that are possible, and none of them are confident that any of those 30 are going to be the one that becomes the dominant case. So I think we're still in the early days of how this will manifest itself into the payment system, and also what the implications are for banking institutions and the banking sector. There are some use cases that could actually be disintermediating, and others could be kind of reinforcing and complementary to a lot of the services they're providing. And right now, I don't have a sense of which ones are more likely or how this is going to play out. And a lot of the legislation that has been passed and that is moving forward, in those things, there are still open questions as to how things would play out. So a lot of this will depend on how those questions get answered as to which things are going to be, or which use cases are going to be the ones that we'll have to have a deeper understanding of to then figure out what the Fed's role might be in facilitating a payment system that works well.
And then I want to ask about just something that a lot of bankers are thinking about right now, which is some of these bad loans. JP Morgan CEO Jamie Dimon describing it as cockroaches that are floating around. I mean, at best, I guess it's a bank that maybe got fooled by a company that's doing fraud. You take a larger allowance, it's not a big deal. The other side of things, is that something that could start another SVB moment? That's something that people are worried about as well. Are you seeing any signs of that in your districts? Is that a worry when it comes to, you know, bank stability on a bigger picture?
Yeah, so we're not, so one, we get paid to worry, right? So we're worrying all the time, and these are things that are sources of concerns. But I will say, I'm not hearing this among the banking institutions that that we engage with, that this is an issue. You know, fraud is an issue, period, and it's been a big issue in the banking sector, as many of you know, for quite a while. And it's been the simple stuff that has been problematic, not the high-tech, sophisticated things. And so thinking about how we create a system that allows us to minimize the amount of fraud is something that we all have to worry about. One area where I do get a little more worried in this regard is that for many of these institutions, they're tied into non-bank sector and non-bank financial institutions where we have less clear and less transparent sight lines. So having a sense of where there are potential spillovers in that context actually is a concern, and it's a question that we will have to investigate a lot more deeply. Today, though, I'm not hearing anything that suggests that this is spilling over into sectors such that we might have systemic issues.
Yeah, it's been a long time since we've seen a proper credit cycle and since we've seen proper defaults. And so it's a good reminder that as you get later and later into a credit cycle, you do tend to see sometimes supervisory practices, compliance practices start to break down a little bit. And so it is healthy, I think, to see some of these episodes and to make sure that individual banks are going through their lending books, they're making sure they're doing the diligence, they're doing the compliance, they're checking um, to make sure things are there. I think the banking system is in very good shape right now, broadly, and the capital levels are healthy. And so I think the banking system is in a position that it could withstand some amount of a default cycle. That's not my base case, and that's not what I'm expecting or hoping for. But if we did see some more of this happen, I think the banking system's in a good position for it. So I'm not worried about an SVB type situation on the back of it. I do think there has been growth in non-bank lending, and then banks coming back and lending to some of those non-bank institutions. And that's something, because as Raphael points out, it is opaque. It's hard for us to get our hands around what the sizes are, making sure we understand all that interconnectedness and what the ramifications, if there were to be a bigger default cycle, what that would mean, I think is something we need to spend time looking at and thinking about.
Great, well, let's open it up to questions now. We've got about 15 minutes. So I think there's a question right there in the back. And if you could just introduce yourself and ask your question.
Hi, how's it going? My name's Paul Egge. I am a banker at Texas Bank, Stellar Bank. The one aspect of the landscape of bank funding that has not been prominently addressed here is the tremendous shift in deposit market share post-Dodd-Frank towards the too big to fail banks, worsened, of course, by the liquidity crisis, and the potential downstream impacts this has on industry structure, really. The playing field for deposits, capital, and financial performance is tilted towards scale, largely thanks to the consequences of legislation, but regulatory structure plays a part too. What are your thoughts on these dynamics and what can be done to improve the overall value proposition of smaller community banks that are vital towards lending at a local level?
So I agree, having a strong community and regional banking system is really important. I think one of the reasons why the US tends to outperform in small business growth is because of that community bank lending that happens. It's that Main Street relationship. I see it when I'm traveling out in small towns like Worcester, Ohio, where you see the local banker who knows the wedding dress store owner and they build that relationship, and he's monitoring her business, he's understanding, he gave her that first loan, and he's helping her to think about what's the right time to expand and how to grow that business. And so there's a lot of, I think, really good economic growth that happens in this country because of those small banks that we have. And deposits are a critical part of it. And so there have been some newer strategies to help mitigate that and to expand the deposit insurance, like reciprocal deposits. That's a tool, like many other tools, that can be used. But I think, an alternative proposal could be expanding deposit insurance. That's not within the Fed's remit, but I do think some of those strategies might help to mitigate some of the imbalance that we see where, in stress, you actually see inflows into the largest banks and out of the smaller banks. And I think that's something that, we need to continue to monitor. Some of the tools we have, like the discount window, are there to help to bridge if some of those liquidity movements are shifting in acute ways, but supporting community banks and ensuring that they have every ability to compete with the larger banks, I think, is critical. You get a different value proposition from banking with a community bank versus banking with a large bank. You get a different level of service, a different level of connectivity. That's what I hear from the bankers on my board and in my district, is that's the reason that they're there, and that their clients will continue to work with them. But I do feel like it is in our interest, both as a Federal Reserve, but also as a country, to help make sure that those small community banks are able to continue to thrive and provide credit to these local small businesses and smaller institutions.
Yeah, so Mike Johnson was on the stage here yesterday interviewing Randy Quarles. Mike was the head of supervision when I started in Atlanta. We wrote a piece maybe 6 years ago about the importance of community banks and how we needed to make sure that market structure and industry structure didn't evolve in ways that put them at a competitive disadvantage. And some of it could be regulatory, and I know there are going to be a lot of proposals in that. Some of it could be industry structure. So it may be that the community banks build a consortium that allows them to have sophisticated interfaces that approximate or can compete with what the big banks can do, because the big banks have resources to build those sort of things in ways that community banks do not. And I think this has got to be an all of the above proposition, because across my district, I got Florida, Georgia, Alabama, Mississippi, Louisiana, and Tennessee. There's a lot of small town in that. And there are a lot of community banks that are serving the vast geography that I'm responsible for. And when I go to those towns, they are all worried that they're being forgotten, they're not being seen, they're not being served. And community banks are built to do all of those things. And so we need them to be strong, and we need to continue a conversation that allows them to have opportunities to tell us the things that need to come together so they can thrive. Because when they thrive, we come closer to having an economy that works for everyone, so that particular communities are not left behind, they're not forgotten, and the smart people, the enterprising people, the ambitious people in those communities believe they actually have a shot to do the things that allow them to be great. And we should be trying to support that as much as possible.
Next question. I think right here.
Hello, I appreciate your comments this morning. We've heard some comments about stable coins, which is primarily a private sector initiative at this point. About 2 years ago, the Fed put out a request for comment on the potential for creating a U.S. Digital currency. And I'm curious as to where the Fed is currently in its thinking about moving forward with that development.
I don't think we're anywhere.
I think there was an executive order that explicitly outlawed a U.S. central bank coin.
Yeah, so that's not happening right now.
But there's been a lot of work that was done studying the technology to understand how the payment system is shifting. And it's really informed a lot of our thinking around stable coins and around what the use cases are and how we can modernize the payment system, how it would interact with FedNow, which is our real-time payment service. And so I think there's a lot of good things that came from that analysis and that viewpoint, but we have a narrow mandate and we're going to execute what Congress wants us to do. And Congress has told us and the president has said that they don't want us to put a central bank digital currency out there, and so that's not going to happen.
Next question. If not, I'm going to have to ask about like Halloween plans. I think there's one back there.
I know Brian already asked about the discount window, and I just want to circle back to that a little bit. Given the discount window is generally used as a backstop during periods of funding stress, how do you assess its current effectiveness of supporting liquidity without signaling weakness? Should the discount window be repositioned as a more active liquidity tool rather than a method of last resort? It's cheaper, it's faster, money can get to banks quicker. If so, what changes do you feel like need to be made in order to make that shift effective?
So I think this raises the question of how do you want to position these tools? I see the discount window as a tool that should be there for banks to take advantage of if they need it, but it's not a regular way funding source. And so that makes it a tricky thing to balance, right? You want banks to use it when they need it, but the fact that they need it then indicates, well, maybe something's not exactly right. Now, that not exactly right doesn't have to mean that there's an existential stress that's happening. It could just be there's timing mismatches. It could be that there's a better opportunity and you can lean on that discount window liquidity so that you can continue furnishing loans to your client base, which I think is an important function for the banks to play in any part of the economy. But how you calibrate that, I think, is a tricky choice. And so I do feel like having it priced at the top of our band, a primary credit rate there, is the right place to do it. We should lend against good collateral. We are happy to continue to provide that funding to banks to ensure that credit is flowing through the economy. But I don't think it's meant to be a bank's first choice funding tool. It's meant to be, I think, a backup for when your normal way planning, goes awry. I think we heard yesterday on the panel that one of the most important disciplines in managing liquidity at an institution, and I say this with some confidence, having done that myself in my prior life, is maintaining diversity of funding sources. You want to make sure that you have as broad a range of sources available to you so that you can, lean in different dimensions, because you never know what's going to happen in different markets or in different segments. And so having robust deposits from your clients, having brokered deposits available, potentially reciprocal deposits, accessing term debt funding markets, maybe CDs, and the discount window is another component of that. The home loan bank system is another component of that. There are a lot of different sources out there, but making sure as an institution that you are using all of those, that you're testing them, that you're continuing to participate, will make sure that you have that diversification of funding, which I think will ultimately strengthen your funding tools for the long term.
So you highlighted something. Everything she said is exactly right. But you highlighted something that's actually a tension with the discount window, in that we do want people to use it, but we don't want people to use it and crowd out other sources and vehicles for getting liquidity. And how you communicate that, and how you talk about that, and how you articulate what the line is that is appropriate is very difficult in a large and dynamic economy. And that's one of the challenges I think we've had institutionally in articulating sort of what the appropriate use for this is. And then I think it's also been hard because the interpreters have an ability to make their own judgment. Like, we may say one thing and they may just take it another way. And so there's implicit risk that I think institutions have been facing that has been a challenge. And when I started here in 2017, we were on a task force to try to reduce stigma in the discount window. That task force is still working, right? Like, we haven't found the answers to this, because I think this is actually a very complex problem that has some technical issues, but there's also a lot of psychology in it that requires sort of working through and trying to find a sweet spot that may or may not exist. And I think that's the effort.
I think we can squeeze one more question right up here. So maybe a discount window rebrand, like the super fun funding
The purple
window.
pandas window?
Yeah, there you go. One final question.
I think it was a tie for us to raise our hands. So I'll be quick.
Okay.
But I'm just curious how quickly you feel that you can implement an operation if you feel that you've withdrawn too many reserves. And in what order do you think that you would do that, whether it's an IORB cut, TOMOS, POMOS?
So that's a great question for the New York desk, who runs the open market operations. They do give us briefings at the FOMC meeting every time we get together, and they're very collaborative and share insights regularly about what's going on. I have every confidence that they are prepared to make sure that the system is filled with the ample level of reserves as they have been directed by the FOMC, and that they will continue to support healthy market functioning in funding markets.
Okay, any final thoughts on anything from either of you before we wrap up?
Well, thank you for being here and doing this. It's been great having you with us. Thank all of you for being here. These conferences only work if people show up and people have thoughts and are willing to share them in an open and collegial way. And I think this has been a fantastic experience, fantastic time, and I've learned a lot of stuff. So thank you.
+1 to all of that. No, this was great, and really, it's such a pleasure to work with Lori and Raphael and all of their teams to help bring this together, and hopefully we'll do these again. I think it's a really good convening. I love when we get the perspectives of academics and practitioners and policymakers all together. I think there's a lot of learning that happens, and it's really where we help to push forward on. So thank you, and thank you for being here, Brian.
Thanks for having me. Well, thanks so much for that wonderful conversation. I think I'm tossing it back to Mark, right?
Well, thank you, Raphael, Beth, and Brian, for a great concluding session. Before we break up, I just would like to extend a special thanks to Mark Jensen in Atlanta, Paola Bowl in Cleveland, and Alessia Soretto in Dallas for putting the meat of this program together. And a double special thanks to all of the people who work behind the scenes on the logistics, the AV, the catering, all that stuff, without which these events just don't go well. There are box lunches available outside. And with that, we are concluded until next year. Thank you all.